Welcome back. You're watching Stockwatch with me, Simon Brown. Joining me to take your stock-related questions tonight, Jean Pierre Verster from Protea Capital Management, Shane Watkins from All Weather Capital. Be sure to send your questions. Email stockwatch@bdtv.co.za, SMS 41392, or on X using the hashtag StockWatch. Gents, appreciate the time this evening. I want to quickly touch on GDP. Shane, let's start with you. Quarter on quarter, minus 0.3%. Agri down, 28.8%. Not a great number, but yes, we've got no load shedding, we've got a GNU and everything, but it takes a bit of time to turn an economy around.
Absolutely. I said on TV the other night that in the 15 years from 1995, the economy grew from 1995 until 2010 by between 3 and 5% per annum.
Yeah.
We then had the Zuma years, which call it another 15, from 2010 until roughly now, where the economy has grown about on average 0.7%, and in some years negative. So, it does take time to turn the supertanker. But I think, my judgment would be at this point, with less load shedding, with lower interest rates, with the government of national unity resulting in better performances from the enablers like Eskom, Transnet, the other big infrastructure players, that, it's realistic to think that we could grow maybe in 2025, 2%. I think market consensus, is about 1.7. But, we could be entering a period where we re-enter that zone where the economy grows 3 to 5%. And I think that's very exciting for South Africa. And because we have this recency bias of, years and years and years of the economy growing less than 1%, we almost anchored in that. And I think, we need to unanchor that and recognize that for once, maybe the sun will be shining in South Africa.
No, I like that point, recency bias, absolutely. Jean-Pierre, we would love 5%. I suppose 2% is a good first step en route to get into that 5. We need it. Our companies have done alarmingly well in a tough decade and a half.
Correct, yes. They've really weathered the storm. A lot of resilience shown by our companies in the last decade or so. You can almost call it the last decade. And sometimes these quarterly GDP numbers are quite volatile. The big negative in this third quarter results to the end of September was agriculture. And we know the rains are very late this year. So hopefully that can see a rebound, especially if we get some good rains between now and Christmas. I see some of the meteorologists are saying it's late, but it's coming. The rain is around the corner, so let's hope so, Simon.
Yeah, Alex.
Simon, also maybe to add,
yeah.
To add that, the Q3 numbers really exclude the impact of what we call the two-pot system.
Yeah.
So the two-pot system in retirement funds is what allows members of retirement funds to withdraw up to 30,000 Rand now and annually. And it's estimated that the two-pot withdrawals so far have been sort of in the 25 to 50 billion Rand range, but that the total impact will eventually be maybe 70 billion. Now, South Africa is about a 7 trillion economy. So, 70 billion would be 1% to GDP. But of course, that money will be spent multiple times. So there will be a multiplier effect on GDP of the two-pot system. And so the numbers that you've been discussing exclude the impact of the two-pot system, which will probably only get reported on sometime in Q1 of 2025.
Yeah, and I saw Alexander Forbes said that their early withdrawals were twice what they were anticipating. But Shane, let's stay with you then, because I got a question coming through about Pepkor, and they should be potentially one of the beneficiaries of two-pot. They've got their mobile business, their flash business, of course, Brazil, but then, of course, Ackermans and low LSM clothing. Is Pepkor looking good? Their results were tough, but their post-period end, which was two-pot money, looked a lot better.
I think Pepkor is exactly that kind of beneficiary. Obviously, 30,000 Rand means more to a lower income person than a higher income person. And Pepkor services lower income people, not higher income people. So the two-pot system will make a much bigger impact on them, as will lower interest rates. Incidentally, the Pepkor management are in Europe with Morgan Stanley this week, going around seeing investors, which is, I think, one of the reasons why the share price has been supported, foreign investors liking the story. And then the other thing is, Pepkor have got a couple of hundred stores in Brazil.
Yeah.
Now, the Brazilian population is, I think, about 180 billion, which is, let's call it 3 times the size of South Africa. So if Pepkor, with this business they have called Avenida, if this business does well in Brazil, I would guess that in, a decade or two's time, the Brazilian business will be meaningfully bigger than the South African business. So I think there are good reasons to like it. I think I punted the share on your show a year ago, and the reason I punted it is that the CEO, Peter Erasmus, has got an enormous option structure. For every 1 rand that the share price goes above 21 rand, his option payout is 120 million. So at the present moment, he's, let's call it 500 million rand in the money on his option structure. Now, I mean, we think that's a good thing, right? Because we like management to be incentivized in the same direction as shareholders. If the share price goes up, we'd like to do well, and so should he. And so I think he's done a great job. But, maybe there's a lesson for investors here that have a look at how the chief executive is incentivized. And Peter Erasmus is heavily incentivized to get the share price up, basically. Yeah. He's not heavily incentivized to earn a salary or to have like some other benefit. All he's got to do is do the thing that's good for you, which is get the share price up, and he's done that very well.
He has, and I like the logic of follow the money. What's the incentive for the executives? Jean Pierre, stock has run well. I mean, is it time to take profits? I would think there's probably more to it, perhaps, in Pepkor.
Well, I think you have other options in the retail sector as well.
Fair point.
So I do think Pepkor has done very well. A lot of retail stocks have done very well over the last 12 months. So it's been a bit of a rising tide. And that's why it's sometimes quite contentious if a CEO is incentivized to this extent, because you can't necessarily differentiate between what part of the share price rise is because of this rising tide, positive sentiment impacting the whole retail market, versus what is the genius of Peter Erasmus. Mm-hmm. And that's why instead of having an absolute number in terms of the share price, what a lot of remuneration committees should do is work on relative performance. So how does your stock do relative to all the shares in the same sector? And I think that's a fairer way of incentivization. Notwithstanding that, yes, Simon, I would probably trim Pepkor at this price. My preference over the last year has been Lewis, which has done also exceptionally well. So I would still hold on to that, even after doubling in the share price or a total return of more than 100%, because you've got a very nice dividend as well. It's still relatively cheap, and I think the furniture sales also are benefiting from the two-pot system. I also like Truworths as another retailer, so maybe recycle some of your exposure, if you've done well with Pepkor, to some other retailers that I think have got better valuations than Pepkor at the moment.
Yeah, and Lewis does I don't want to say aggressive, consistent share buybacks, which obviously helps as well at the same part of the process. So it wouldn't be Stockwatch without a question. Jean Pierre, Sasol. I mean, it's $90, it's cheap. I don't know, it was cheap at 150, it was cheap at 190. Is there hope for Sasol at 90?
So I think I've answered this question 4 shows in a row, so I'll keep it short. No, Sasol, in my opinion, is a value trap. I believe it will keep on trending downwards, because I believe in 10 years' time, there's a risk that Sasol doesn't exist. Mm-hmm. Either carbon taxes will tax it out of existence, or they won't find sufficient gas and the quality of their coal will decrease, or we'll use less plastics and therefore the US operations will not generate a return above the cost of capital. But I see a lot of negatives for Sasol, not very positives. It might look optically cheap, but that is the definition of a value trap. It looks cheap, but it probably gets cheaper because it's a deteriorating business.
Yeah. I've been caught in some of those in my life, and I take your point. It looks cheap, it doesn't mean it can't go cheaper. Shane, Sasol, any hope?
So I largely agree with what JP says. I would say that if you buy Sasol now, you're hoping for some corporate restructuring. The reality is they own 50% of a huge business in the United States called Lake Charles.
Yeah.
If they were to sell the 50% that they have left, that could add 50% to the Sasol share price quite easily. But that's a big if. And I think the lesson maybe on this is that, if you buy shares because you think they are undervalued, your upside is 10, 20, 30, 40, 50%, and then it's done. That's the most you can hope for. Where if you can find a compounder like Pepkor, you can make 20% per annum for a decade or 2 decades. I mean, if you look at Capitec, I
Yeah.
mean, Capitec, when I started looking at it in, I think, 2001 or 2002, the share price was 3 Rand. It's now 3,500 Rand. All you had to do in 2002 was buy Capitec and do nothing. Where, the difference between that opportunity and a value opportunity is a value opportunity is extremely limited. It's why, I think value investors haven't done well. There's a fundamental flaw in some ways in the way that they work, in that, you need to get every single one right, and the most you can hope for is 25 to 50%, where if you get a growth opportunity right, you can have literally tens of thousands of percent return over decades.
Yeah, no, I take that point. I remember Capitec. I remember the IPO. It was the same week that Sambo went into that went bust, and that truthfully scared me a bit. We're going to break in a minute, Jean Pierre. Before we do, Intel question coming after the CEO got fired on Sunday, and I appreciate they say retired, but retired, fired. Is there opportunity here? This is a stock that's got a long way back as well. Intel.
Yeah, retired with immediate effect.
Yes.
That tells you something.
Like 20-minute notice.
Yeah, look, they are still what you call a fab. They are an integrated circuit manufacturer. So they design and manufacture these integrated circuits. And that model has been shown not to be the best model. You have TSMC and a few others who are just fabs. They're not integrated. They don't design. They only make the chips. And that's a very capital-intensive business. And then you have the likes of NVIDIA and Broadcom and Qualcomm, and they design chips, but they don't fabricate them themselves. And that's a great business, very capital light. So you probably need to be one of the two. And Intel has held onto this business model of being an integrated semiconductor company. That doesn't work. So that was part of Pat's vision, is to stay like this. After he has stepped away, you'll probably see a break up of Intel.
Yeah.
And with that breakup, you'll probably see different other bigger companies wanting to buy the two different bits. So there could be some corporate action. That means, yes, while the news is very negative right now, the silver lining is it means that Intel is in play and there could be corporate action. So it could be an opportunity, a value opportunity, not a growth opportunity.
Value. Shane, notwithstanding that it is a value rather than growth, it's a corporate action in Intel perhaps more than anything else. Would Intel be on your radar with a suddenly retired CEO?
Simon, I suppose, yes, I would say. I mean, the share was, let's say, $70 2 years ago. It's now, call it 30. Clearly it's moved in completely the opposite direction to the other players that have slightly different business models, as JP Verster said. But, long NVIDIA, short Intel has been like the trade of the century. But I mean, look, they have a good brand. They obviously have good manufacturing capabilities. And I would imagine that if they put someone in there that could sort of unveil a half sensible strategy, there could be value to be unlocked. But obviously turnarounds sometimes don't turn.
Yeah.
So I guess we'd have to wait and see, what the new CEO, when he is appointed, what he does. I mean, there are other examples like this in the United States where the leader has fallen, right? I mean, Intel isn't the only one. We all bought computers that proudly said Intel inside, like it was, that was the endorsement. But I mean, look at Nike. And Nike also had a CEO that made a terrible mistake where he tried to disintermediate his own customers by selling Nike shoes online instead of going via the trusted retailers like JD Sports or someone. I think these businesses are fixable, and these are just kind of strategic errors that, have had appalling outcomes.
Let's stay with you, Shane. Let's take a bunch of questions coming through around Boxer and Pick n Pay. Let's start with the Boxer one. Certainly a good listing. 54 Rand was the price. Traded up, I think I saw it as high as 68. If you got it 50, question is, if you got it at 54, should I be taking my money? The other question was, is there more upside? Shane, Boxer, it's been a great listing, but it's a long road ahead maybe. What's your take on the valuation at current levels?
So Boxer's a growth story, and they have, I think, about 550 stores, and they say they will double that in 6 years. So it's an obvious growth story, right? It's a little bit like we discussed Capitec or Pepkor. They're growth opportunities. They're not value stories. So, you must be prepared to pay a lot for something that is going to grow significantly. I would guess Boxer at the moment is on maybe closing in on a 30 PE, and they're probably likely to grow at 20-25% per annum. So I think that, probabilistically, stay with Boxer. I noticed that one of the directors was actually buying shares
Yeah.
at 66 Rand. There was a SENS announcement today. So insiders think it's a good story. So I would stay with it. The other thing that I would caution you against is we're getting to the end of the tax year. And if you sell now, you will crystallize a taxable gain and you won't capture that full 25% that you have made on an unrealized basis up till now.
Jean Pierre, Boxer. I mean, it's great to have a new listing on the JSE. Your take on it from an investment perspective?
Yes, great to have a high quality listing on the JSE. And I do believe it is a high quality stock, high quality growth stock. And the trick about these high quality growth stocks, We Buy Cars is another one you can mention. Outsurance may be another one. Is they look expensive and they generally stay expensive. But because the earnings growth is above average, they tend to just keep on growing in line with the earnings growth at an above average rate. And you rarely get a chance unless you have a big market implosion almost before you can get them cheap. So you either need to be very, very patient and wait till you have a bear market and then you buy these high quality stocks, or you sometimes just, close your eyes and buy them even at a full valuation, with the risk that if they do set a foot wrong, the share price can come down sharply. And sometimes management teams do make strategic mistakes. But the simpler the business, also the less chance of that happening. Boxer is a relatively simple business. So yes, in the mid-60s, it's full. A 30 PE is not cheap, but because it's high quality, I would not sell what I have. And I might try to be a little bit cute if I wanted to buy some more and look for a slightly lower price.
Yeah, and I tell you, I waited for a bear market, and it came once, and the price was still not at the price I had wanted anyway. So I gave up on that as a mug's game. Jean Pierre, let's stay with you then. What about Pick n Pay, which of course is the remaining, although they've got a chunk of Boxer in there. Now that we've got a valuation on Boxer, does that change the picture? Is Pick n Pay looking good?
So Pick n Pay is the value opportunity between the two, and it's trading at a slight discount to its holding in Boxer plus the rest of Pick n Pay. The rest of Pick n Pay is now effectively debt-free because of the more than 8 billion they got in from the listing and another 8 billion before that, so from the rights issue. So you can make a case to say that the sum of the parts of Pick n Pay is quite a bit higher than the current Pick n Pay share price, which is the value case to be made. However, I think it'll be another at least 18 months before the Pick n Pay brand is at least break even. And they need that money to invest back into the business to get to that point. So between the two as well, I would go for the more expensive but higher quality business and own Boxer directly versus going for the value opportunity in Pick n Pay because of the issue. I think the legacy Pick n Pay stores will still be for at least 18 months.
Yeah, and Shane, it comes back to another one. Turnarounds are hard, messy. Sean Summers has the pedigree, but he has to do it. Would you have Pick n Pay on your shopping list at this point?
So we own both. I would say that the way that we gather intelligence on Pick n Pay is by talking to the large property landlords that of Pick n Pays, and there seems to be good evidence that Sean is having an impact. He's lucky in two regards. The first is that the business was so appallingly managed up until he took over that there are easy wins for him. And the second is that just as he took over, the economy has started to turn. We have all these positive things. We have lower interest rates. We have high GDP growth forecast. We have the two-pot system coming in. We have greater consumer confidence. So I think it gives him a better chance of turning the core business around. And remember, in the core business, most of it is profitable. I mean, the franchise stores are profitable. The liquor stores are profitable. The clothing stores are profitable. It's just the 400 corporate stores and the 22 hypers that are unprofitable. So we know what to fix, right? So I think it's doable, but perversely, I would say a lower risk strategy is to own Boxer, where there are no problems and growth is pretty much baked in.
Yeah, and they get the same benefit from rising GDP, two-part, no load shedding, etc. Shane, let's stay with you. Question coming through around Anglo Platinum. Completed the sale by Anglo American, although there's still the unbundling. Low-cost producer, PGMs, well, PGMs stuck at this point in time. Would Anglo Platinum be on your shopping list in the PGM space, or would any PGM stock be on your list?
I would say Anglo Platinum, not really. They've done two placings of about 5% each, Anglo American has. And they've done that because for them, the value of Amplats is not reflected in their share price at all. So if something is not reflected and you can sell it for something, you may as well do that. And so they've done that, and they've reduced their exposure to now around 70%, or slightly below. But what they have said is that part of their process, and they've said it will be done in 2025, is what they call a demerger, which is basically just unbundling it to existing shareholders. There will be some benefit to that because most indices are free float weighted. So if they go from being a 30% free float, because Anglos own 70%, to call it 100% free float, there will be a significant upweighting of Amplats in the indices, which will see all the passive funds and all the funds that are benchmark cognizant forced buyers of Amplats. But I think I would wait for that event to happen. I mean, they plugged the market twice with 5%, and now they're going to unbundle the balance. So I don't think you need to be in a rush to own it. I mean, notwithstanding the fact that it's probably the best PGM asset, and I think it's got pretty good management.
Jean Pierre, I mean, Anglo Platinum or PGM miner in general, I mean, the PGM stocks, the metals rather, they rally and then they just shift back. We get reports from the Platinum Council telling us deficit again, didn't help this year, didn't help last year. PGM's on your list?
Just tell me what the metals are going to do, and I'll tell you what the stocks are going to do. The problem is we don't know what the metals are going to do. They are very, very much exposed to the internal combustion engine through catalytic converters, some fiberglass and other glass for rhodium. But I mean, the major use is still to do with catalytic converters. And with EVs, even though the uptake is slower, hybrids, where the uptake has been stronger in terms of acceptance by the general public, uses a lot less palladium and platinum for their catalytic converters. So no, we probably need some innovation, some new use for these PGM metals. They are very special if you look where they are on the periodic table, but we'll need to find something. Even the helium economy hasn't really taken off. There was this idea about fuel cells and helium where you need platinum, but no. So no, I would avoid it.
So let's go to stock picks. We've got a minute each. Shane, you're going with Supergroup, and I imagine, and that's the announcement, was it last week, on SG Fleet in Australia?
Well, look, short answer is Supergroup's biggest asset is SG Fleet. It's about 75% of the value of the company. They've said they're going to sell it, or they intend to. There's no firm intention, but they're in exclusive negotiations. I spoke to Peter Mountford today, and all he would say is they will tell us something within the next week. My guess is they will sell it. If they do sell it, the remaining businesses are on about a 2 PE. If you put the remaining businesses on a reasonable valuation, let's call it a 6 to 8 PE, there's something between 25 and 50% upside in Supergroup.
Okay, some good stories there. Jean Pierre Verster, you were going to go Supergroup, but then rather than double up, you've gone with Brambles in Australia. They make pallets. And I know this because I Googled it, to be perfectly honest.
Correct, yes. The major subsidiary is CHEP. And if you think about pallets, it's basically the wooden little structure, 1 meter by 1 meter, that they move stuff around. So if you unload a big shipping container, or if you move stuff around in a warehouse, you probably are using some pallets. There are millions of these things around. And CHEP is a major player internationally. They lease them out and they recycle them. Also some other containers that they do similar things with. And if you think about world trade, notwithstanding Trump and China and the fights that are going on there, more stuff is moving around every year as we ship stuff around, move stuff around. And that means logistics has got an inbuilt growth rate. That means we need more pallets. And with the biggest network of pallets, you've got the network effect, meaning that the more pallets you have out there, the bigger your competitive advantage relative to your competitors. And it's a big business that recycles plastic and wood. Who doesn't like that? Who doesn't want to recycle? So you'll get a ESG a star as well if you invest in them. So a very nice Australian business that has looked reasonably priced for a while, and now with the management team that is really focusing on the financials, I think the future for Brambles looks bright.
We'll leave that there. It's all for Stockwatch tonight. Thanks to our guests, Jean Pierre Verster from Protea Capital Management, Brambles listed on this ASX, and Shane Watkins from All Weather Capital. He's going with Supergroup. Up next, the close. Stay tuned.